We're looking at the price of crude oil, which has been a key factor in the market rally, particularly for the TSX. And of course, this all happened last week as we saw tensions flare up between Israel, Iran, as well as Lebanon. There's still no supply that has been knocked offline, but it seems like markets are on edge about that prospect. And of course, we'd be remiss if we didn't mention the significance of today, specifically for Israelis and Jews around the world, when the one-year anniversary of those horrific October 7th attacks. So as Israelis think about that, we are still 1 year on this very brutal war that has meant different things specifically for crude. Let's bring in Andrew Botterill, who's an energy resource and industrials partner at Deloitte Canada. Andrew, thank you so much for joining us. As I mentioned, the war, especially as it relates to oil, sometimes it's front and center, sometimes it recedes into the background. Right now, here it is front and center again.
Absolutely. And I think you hit the nail on the head there. There is some nervousness in the market, right? Recognizing that while we've had a remarkably stable oil price in the last year or so, we are at a point where it does feel that there's a lot of concern out there that we're going to see the Middle East get into a deeper conflict. And you're right, start to affect some of the production that might be there.
And I think it's worth underlining the point that up until now, it has not materially affected. And when we saw a flare-up in tensions in April, oil moved higher, but then ultimately faded because there was no disruption. Would you say that this time is different or has the potential to be different as discussions are potentially underway about attacking Iranian infrastructure?
Well, I think that's a great observation on the last year, and that is true, is that ultimately there's been always that concern on what the larger conflict's going to look like in the region, but it really does come down to if infrastructure is affected and if we see production leaving. So we're not there yet, but I think the market starts to price that in with the uncertainty and the concern.
So much of these tensions have been overshadowed at times, and certainly in recent history, about concerns of the demand picture. And now that you've got the U.S. seemingly doing a lot better on Friday and huge stimulus coming into China, is the demand environment perhaps more supportive than it was back in April?
Well, you're right. It has been a little bit of a surprise this year. I think we expected demand to be a little more robust. Of course, interest rates and kind of slowing economies this year maybe tempered that enthusiasm. I think there still is a little bit of concern when we look into 2025, because if we've demonstrated anything around the globe is that we have the ability to bring on production and meet demand quite quickly. So U.S. is an example. OPEC could still release volumes as well. So I think while we expect, more volumes could come into the market and demand could be stronger, I think there's a little bit of concern that we need to be tempered in that enthusiasm.
Today we've also got a deal in the energy sector, yet another example of a foreign player leaving Canada's energy sector, and a made-in-Canada solution to that asset sale, CNQ buying the assets from Chevron. Canadian players have really been very active in that part of the consolidation. Do you see any change to the interest, the foreign interest, in Canada's energy sector?
Well, you're right. This is a symptom, and we've seen this for the better part of the last 5 years as many of the U.S. producers have exited Canadian assets. I think what we do see is, and I see this as a hallmark of a strong Canadian solution, like you mentioned. And I think both American players, Canadian producers as well, they're really focused on if they're going to acquire and they're going to grow assets, it's those assets they have the greatest control over. And it's the assets in which they are most integrated into their operations. And so while Americans, I think, have taken a lot of capital and moved it back into the United States, and these deals are an example, you also see companies like CNQ stepping forward and saying, okay, well, we're going to continue to up our integrated nature here, invest in the Canadian assets, and investing in assets that are uniquely tied to us, and we can be exceptionally efficient and manage costs on them.
And perhaps get global oil pricing versus the discount that you get for Canadian energy prices. That discount got pretty wide a couple of months ago. It's starting to narrow. How do you think about that evolving, the Canadian discount to global energy prices?
Well, I think it's something that we've dealt with for honestly as long as the Canadian producers have been around, in that Our primary infrastructure is to get volumes into the U.S. market. Now, with expansions on pipelines into TMX, LNG Canada, for example, on the natural gas side, what you do see is Canadians making some bets into getting more volumes into the global market. So it's a great opportunity for Canadian volumes, but it's not as huge a piece of our infrastructure as we would like it to be.
Certainly, there has been a recent scramble for assets. There's been a flurry of M&A activity, big, huge consolidation. Do you expect that to continue? Do you expect Canada to play a role in that?
I do. I do expect it to continue. I expect a robust 2025, and it's really on the backs of, minus the fact that we started off talking about the Middle East conflict, but minus that, we've seen an exceptionally stable period of global oil prices. Better part of 18 months has been quite steady, meaning that we're seeing buyers and sellers come together. And that steadiness of the market has allowed companies to be really focused on how integrated they are, be really focused on how they're managing costs, and what are the tuck-in acquisitions they can do. So I think we're going to continue to see that consolidation happen. It's in assets that companies feel that are going to add to their efficiency and be able to manage costs and make them more resilient in the long term.
Andrew, thanks so much for joining us with this insight. We appreciate it. That's Andrew Botterill joining